Every government on earth tells the same story. They say money is scarce, they say budgets are tight, they say debt is unavoidable. And yet somehow when banks fail, trillions appear overnight. When wars begin, funding is never the problem. When markets collapse, central banks conjure rescue packages out of nothing. So here is the mystery that should stop you cold. If money is so scarce, why can it always be created when power is at risk, but never when people are tonight? We're re-exposing the financial illusion that keeps nations borrowing from thin air, an illusion so normalized that most citizens don't even realize it exists. This isn't a story about greedy politicians or reckless spending alone. It's about a system built on a contradiction, a system where money is treated as both scarce and infinite, depending on who needs it. And once you see how this illusion was built, you'll never hear the word national debt the same way again. For most of human history, money was simple: gold, silver, grain, labor. You couldn't spend what you didn't have. Kings who overspent faced revolt. Empires that debased currency collapsed under inflation and distrust. Money had weight limits, consequences, but that limitation was a problem for growing states. Wars were expensive. Empires expanded faster than gold mines, and rulers began asking a dangerous question. What if money didn't have to exist before it was spent? The answer didn't come all at once. It emerged quietly through banks, ledgers, and promises. In medieval Europe, goldsmiths stored valuables and issued paper receipts. Those receipts began circulating as money. Over time, goldsmiths noticed something crucial. Most people never came back for their gold, so they issued more receipts than gold held. That single insight planted the seed of the modern financial illusion. Money no longer needed to exist physically, it only needed to be believed in. By the 17th century, governments discovered banks could solve a fatal problem. States wanted to spend beyond taxation. Banks wanted interest-bearing assets. Debt linked them together. In 1694, the Bank of England was created not to protect savers, but to fund war. Private investors loaned money to the crown. In return, the state guaranteed interest payments funded by future taxes. This was revolutionary. For the first time, a nation didn't need to earn money before spending it. It only needed to promise repayment. Debt wasn't a temporary measure anymore. It became infrastructure. Governments learned something even more powerful. By borrowing from banks that could create money through lending, they were no longer constrained by existing wealth. They could spend first and worry about consequences later, and that's when the illusion truly began. Fast forward to the 20th century. Gold standards weakened. Central banks consolidated power. Fractional reserve banking became the norm. Here's the mechanism: simple, but devastating. When a bank issues a loan, it doesn't lend existing money. It creates new money digitally by expanding its balance sheet. That loan becomes a deposit. That deposit becomes spendable currency. And suddenly, money exists that didn't exist before. But there's a catch. Only the principal is created, not the interest. Which means, system-wide, there is always more debt than money available to repay it. This isn't a flaw, it's the engine. Because if all debt were repaid, money would disappear from the system. Debt must grow or the economy collapses. So nations are locked into perpetual borrowing not because they're irresponsible, but because the system demands expansion. By the mid-20th century, this illusion reached a breaking point. World War II drained gold reserves. The Bretton Woods system tied currencies to the US dollar, and the dollar to gold. But as spending exploded, wars, welfare, global influence, foreign governments began asking for gold instead of dollars, and in 1971, the illusion cracked. President Nixon closed the gold window. The dollar was no longer backed by anything but faith. From that moment on, money became purely symbolic numbers, backed by nothing, issued by authority. And here's what happened next. Debt exploded. Global debt didn't rise slowly. It accelerated decade after decade. Governments could now borrow without natural limits. Central banks could print without restraint, and financial markets adapted to this endless expansion. The illusion was complete. Once money detached from reality, consequences followed. Inflation became structural. Asset bubbles became normal. Crises became cyclical. Each collapse followed the same pattern. 1. Easy credit fuels growth. 2. Debt outpaces income. 3. System destabilizes. 4. Crisis erupts. 5. Central banks intervene. 6. Debt increases further. The solution to too much debt was always more debt. 2008 exposed this illusion brutally. Banks created mountains of debt. Risk was disguised as innovation. When the system failed, governments borrowed trillions to save it. Not from savings, from thin air, and the public was told this was necessary, inevitable, responsible. But notice who paid the price. Wages stagnated. Housing became unaffordable. Inequality exploded. The illusion preserved the system, but transferred the cost downward. After every crisis, reforms are promised. Stricter regulations, transparency, fiscal discipline, but none address the core illusion, because the system cannot survive without continuous borrowing. Balanced budgets are political theater. Austerity punishes citizens, not the structure. Regulations get captured by the institutions they're meant to control. Even alternatives like printing money for the people face resistance, not because they're impossible, but because they threaten power alignment. The illusion isn't about economics, it's about control. Who decides when money appears? Who benefits from interest? Who absorbs inflation? As long as money is created through debt, power remains concentrated. Today, global debt exceeds multiples of world GDP. Central banks hold unprecedented power. Digital currencies promise efficiency but increase surveillance. Emerging economies are trapped in dollar-denominated debt cycles. The pattern is unmistakable. Borrow to stabilize, borrow to grow, borrow to survive. And yet, governments insist there is no alternative. But history tells a different story. Systems collapse not when debt exists, but when belief fails. And belief is fragile. Takeaway 1. National debt is not borrowed savings, it's created money with political consequences. Takeaway 2. The illusion of scarcity justifies control, austerity, and inequality. Takeaway 3. As long as debt is the foundation of money, crises are guaranteed and not accidental. The real danger isn't inflation, it isn't collapse, it isn't even debt itself. It's normalization. When societies accept perpetual borrowing as reality, they surrender the right to imagine alternatives. So the question isn't whether this system will end, it's who will pay when belief finally breaks. If this changed how you see money, debt, and power, share it with someone who still believes national debt works like household debt. Subscribe for deeper breakdowns of financial history, hidden systems, and economic illusions. Because once you see the mechanism, you can't unsee it, and understanding the illusion is the first step toward escaping it.